really what this is a culmination of what started in 2009 as a result of your favorite policy by the Federal Reserve.
Low rates.
John, right, exactly. So, since 2009, we've seen around 900 billion of high-yield bonds issued, and the amazing thing is that it's still accelerating. And the reason that it's accelerating is that investors, both institutional investors and individual investors, can't find yield anywhere else.
Right.
So they used to hold treasuries. Treasuries are, a 5-year treasury pays you 1% right now. They used to own investment-grade bonds. Investment-grade bonds, on average, return 3 point something. It's inflation. If you want to beat inflation, you need something else, and that's why they're all going into high yield. So, in the first quarter of this year, we saw 18 billion go into mutual and ETFs, mutual funds and ETFs that are focused on high yield. Now, you guess that that's around 20% of the overall investment pool into high yield, which means that in this quarter alone, around $100 billion went into high yield.
Wow.
And
we've heard this, we've seen this movie before, though, right? The hunt for yield, the need to get there. And junk bonds are called junk for a reason, an invention of Michael Milken, of all people. I mean, is this a risk? Do we have a kind of a CDO problem here?
Is this bubbly?
Okay, it's not frothy, it's not bubbly, it is a risk. There is a risk, and there's a real risk. What high yield has done historically is lag economic cycles in terms of default rates by about a year to a year and a half. So when we have an economic downturn, about a year and a half later, we have a steep increase in default rates, and we have major losses in high yield. High yield is, and probably always will be, an illiquid asset class. And so it responds very quickly and very radically to those moves. And the difference now, as opposed to the previous default cycles that we've experienced, is that so much of the investor base now is hot money. It's retail investors that can buy through ETFs, which they can never do before. They can buy through mutual funds, and because they never thought to buy high yield before, because they could get a decent return in other sorts of fixed income, now they're becoming more familiar, and more players.
Are they savvy enough to get out as quickly as they might need to be in the scenario you were painting there?
I mean, if you look at what's happened in the equity markets, and you use that as as a bellwether, probably not. The good news is they're not going to need to worry about that for a while, and the reason is that the default rate right now is 2%. Most of this 900 billion went to refinance debt for high yield companies, so they don't really have maturities anytime soon. And so the difference now is, and one of the things that I tried to get across in the story, well, for the past 3 years, we've seen issuance increase, and that's helped all these companies, and they've built a healthier balance sheet. The real difference now that I see is that the rate at which they can finance is lower than it's ever been in the history of high yield bonds. The average yield on new issues is now below 8% for the first time in history. Wow. That has never happened before.
So, in terms of duration, then what you're saying is that the interest rates aren't expected to go up very quickly, so there's not a sense that there's going to be a lot of pressure on these bond prices.
Well, not in the near term, but I think that rates go up, meaning interest rates will go up before default rates go up. And so the real risk that I think a lot of investors in high yield are taking now that they don't realize is they're taking duration risk. They're taking risk that's tied to where Treasury bonds go.
It's the big risk that's out there, really. The bond market risk is arguably one of the biggest threats hanging over the markets as a whole, because when these rates turn, there's so much money geared up in.
Is there any when you look back historically at times when there's been a lot of muni issuance like this, is there anything that we can see, like in terms of overpricing, or what happens when
you've seen cycles in high grade, investment grade, where the benchmark goes down, rates go down in investment grade, and then when rates come back up, investment grade gets punished. And what you're going to see, what we're seeing is a somewhat secular shift in high yield, where for the first time, high yield investors are also going to get punished when rates go up in a meaningful way. And that's a risk that I don't think most people understand. So there's always been this conventional wisdom that you don't really need to, that high yield outperforms in rising interest rates against other fixed income. It will still outperform, but to a lesser extent.